Yo, what's going on, guys? So I just want to make a quick video, kind of like identifying liquidity and where I get my liquidity targets. Like, what lows should we target? Because there's so many different lows and highs, right? Like, we can literally just, call this liquidity. We can call these lows liquidity. So, I just want to show you how I go about it. So I have like two different methods, but they kind of like intertwine together. First things first, get off the 1 minute chart there. Um, First things first, I look for your smooth highs and lows. You guys hear me say this all the time, right? All of our smooth lows and highs. So when we're down here, you kind of see this, right? What's this look like? Accumulation, manipulation. Here's your distribution back up. And it makes sense. Why? Because look, if we draw a box here, like anybody that's your newbie-ish traders are going to be all their stops are going to be right here at these smooth lows. Look down here, all these smooth lows. Like when it's you see wicks like this, the damage has already been done, and the damage has been done already, and you want to attack up in look where the smooth highs are above, and vice versa. If the damage is done up here, where do you want to look? You want to look down below, and look when we went up here, we came back down. Look, there's equal lows sitting right here, smooth lows, right? So just always be looking where your smooth lows and highs are. Look, so on the manipulation leg, we we come down. We make like it's kind of like a knife, right? Like it's a serrated side of the knife, and you want to attack the smooth side. So, kind of what that's how I look at it. It's always like on the 15-minute chart and the hourly chart is where I find my like big liquidity targets, right? And then we use like the 1 to 5 minute chart for inverses or order blocks to help take us up to that target. So you see the manipulation came back up here. I mean, it's just it happens like everywhere, right? Like sometimes, yeah. I mean, there's a little damage down here. We can now take this low, right? We took pre-market lows, London lows here, and then we go back up. But what else do you notice? There's smooth lows in here, right? Just always, that's just how I look at it. Just think of it like a knife. You want to attack the smooth side, not the serrated side, right? All right. So with that, I mean, you pretty much get the point of that. That's as basic as I can make it. You see like smooth highs here. What happens? We come back for it. It may not be immediately, but we're probably drawing back to there at some point. So it's basically just looking at your relative equal lows and highs on the 15-minute, 1 hour chart is really what I use. Um, and then of course, like when we have LRLR, there's this is the trade that I went over today. Been doing a lot of back testing with this. And obviously there's one more way to look at liquidity in the form of like these very algorithmic. The highs line up very nicely. Um, to either the upside or the downside, right? Because we know anybody that shorted here or in here, where's their stop? At the swing high. So when the market comes back up and takes that stop, what happens? Those orders get into the market in what? In the form of buy stops, and those buy stops then get into the market. An influx of order and liquidity comes into the market. It's enough to it's that domino effect to the next high, and then the buy stops at this high get stopped. What happens next? We push up, and then we know we have the equal highs. But this is why I held up to 59 this morning. Um, Still working on this, but why did I hold for 59? 59 is right here. So the big word is going to be failure swings. So when you're looking at liquidity, like this is just a 1 minute chart, but I mean time is fractal, right? We can look at it on every chart. Failure swings are these. So it's this high, this high, this high. All these highs that fail to take this high is where liquidity is going to be, but it's not your big liquidity targets that the market is after, right? You could look at this one, but you could even say this is a failure swing of this high, and you see we still went up to up to 72. But I was watching here because of these. You get failure swings, you get this, you get this. When we pumped it open and we took this high and the end of this high, I wasn't concerned of us dumping. I was looking for a 50% retrace in our dealing range. A new word, right? I haven't gone over this too much. ICT obviously has, but what is our dealing range? So our dealing range is when we take sell side or we take some kind of low, which today I'm gonna really mess up up the charts here, but where was open? So this was open, right? Oh, I just showed this to you guys. We take this low, right? And we start to move. What happens here? We take this low, so that's our sell side liquidity, right? That's our big target. Let me see if I can get back here. Um, and so we're back here. Um, our dealing range is this. What makes a dealing range? So a dealing range is when you take sell side liquidity, which we did right here, right? I'm not gonna go back and show it again and mess up the charts, but this is our dealing range, and we know we still have buy side up here. Why? Because we have all these failure swings. These highs did not take the main high up here that put all of these these failure swings in. So your big liquidity is going to be sitting here. Market should run to here. So what makes a dealing range? A dealing range is the low from the sell side and the high after you take a like any high, right? So we take this high. This makes our dealing range. We want to be looking for longs. You can backtest this. Happens 95% of the time. If we take sell side, and we get a dealing range like this that takes a high. Remember, dealing range is confirmed after we take this high. We are then looking for 50% of the dealing range to look for a long position. Um, Back up to our main target. As long as 59 did not get taken, we can look for a longs back up to 59, right? So what's our target? Obviously 59. You see we have 50%. Where can we enter? We are looking to enter either in this 1 minute FVG. You can wait for confirmation. You can wait for some kind of inverse back up, or anything. There's a 1 minute inverse here. You would have went up here, went break even, and then got stopped at even. I'm personally watching these 1 minute order blocks that form after sell side. So this is your order block. Most of the time, you will notice when we take sell side and we have displacement up, we will put in a 1 minute order block here, right? This is your order block, and notice what happens when we pump up. It's kind of like an FVG, right? There wasn't also a 1 minute FVG here. What happens? We leave it. We leave it to come back to. A lot of people would say this is a bad long because we took all these highs. We're probably gonna dump back through. No, it's just the market in the dealing range coming back to fill everything that it left, and then induce shorts and then go back up higher. So on my demo, I entered right here at 21, and I was not selling until we hit 59 or we took a new low. If we took a new low, I would have counted it as an L, but that's what I'm just watching. So I'm watching this OB. Another place you can put your stop on this would be like if you look at the 50% of that OB. Look at this. We wick 50% of that order block right back up. 50% is everywhere, guys. So just pay attention to it, and then you see what happens from there. So a lot of people will like if 50% of this order block gets disrespected and we close below it, most likely it means we're going to continue lower. A lot of people would stop out there. Just for my demo purposes, I was just with a stop down here. But you can see how 50% of this order block was respected, and how I had the conviction to hold even after we took these equal highs, like most of the times people do. No, absolutely nothing wrong with that, right? But just something to get you a little bit more and to start identifying higher liquidity targets. So just something, just remember failure swings right here. Wherever that high was is where the market is most likely going to draw to. So failure swings are huge. Watch those. And then this was just something that I've been watching. Remember dealing range, and then if we get above here after taking sell side and we don't take our big liquidity target, most likely we're still bullish. Look for 50% of that dealing range. We usually come back to at least 50% or a big FVG in that range, and then we go back up higher. So just want to point that out to you guys, show you guys. Like I said, I had a bunch of questions, so hope you guys learned something. And if you have any questions, DMs are always open, and we'll catch you guys later.